This is Duke University.
Hello everyone. Welcome to this edition of the Fuqua Conversations. On behalf of the Fuqua School of Business, I welcome all the alumni and thank you all for participating in this live session. My name is Mohan Venkatachalam. Some of you know me as Dr. V. And sitting alongside me is Professor Bill Mayew, who's also of the accounting department. Before I continue, I want to let you know that if you have any questions that you want to share with us, you may want to use the tweet by using the #Fuqua alumni hashtag. So the topic for today's conversation is how executive voices can be a carrier of information and what can we learn from when executives converse with various participants in the stock market. The first question that might come to mind to you, but you may not be willing to ask, is what has this got to do with accounting? When you took the financial accounting course, either from me or Bill or some of our Fuqua colleagues, the first thing that they repeat themselves is accounting is the language of business. When we think about accounting as the language of business, we think about how managers communicate their information through financial reports. And oftentimes the financial reports is viewed in a very restricted manner in the form of financial statements, the numbers that are being produced to convey how the firm has done over the years and what the action plans are by the management. But little has been done in terms of understanding when managers communicate outside of the realm of financial reporting. So Bill and I have basically extended this boundary of financial reporting in understanding how managers communicate and what we can learn from these communications, both in terms of what they're telling about the firm and also about themselves. So in that sense, I think it has a big role for enlarging or widening the role for financial reporting. Now, Bill's expertise comes in the form of understanding earnings conference calls. His dissertation was on how managers allow analysts to participate in the conference calls. We use that as a starting point for understanding how executives convey information and what can be learned from all the things that they say during those conference calls. Now, what I'm going to do is I'm going to let Bill provide us with an elevator pitch, pun intended, about some of our research findings. Bill?
Great. Thanks. Well, welcome everyone. I'm thrilled to be able to share this research that Mohan and I have worked on for quite a while now with you. And as Mohan mentioned, a lot of my research focuses on the earnings conference call, which is a relatively new venue in the last decade for managers to speak with public markets. And so in the early 2000s, there was a regulation change where managers of public corporations could not disseminate information privately to analysts, for example. And as a result, there became a boom or a market for a public broadcast where managers would simply publicly announce information. And that's the venue, that's what an earnings conference call is. Well, it opened the doors to studying a wider notion of communication in terms of corporate management. And so your typical conference call will last an hour. What will happen is there'll typically be a CEO, a CFO on most calls. There may be a vice president or a manager of a particular division, but it's very standard that for sure the CEO and CFO will be on the conference call. They'll present their performance for the fiscal quarter. Usually that'll take up to 15-20 minutes. The CEO and CFO will take turns. And then they'll open up for live questioning, whereby analysts will queue in and try to ask a question of managers. And managers will answer their questions live. So the analyst you'll hear the analyst ask the question. You'll hear the manager respond back to the analyst, and that iterative dialogue is actually live. And as you might imagine, that opened the door up for thinking a bit more broadly about financial communication, how managers actually tell the market about how their firm's doing. And so the role of financial accounting, which is obviously important, and we don't mean here to suggest that this is going to take the place of any financial reporting. In fact, the earnings conference call is meant to discuss the numbers that are actually going to be presented to the market. And so it's a combination venue where the managers are going to talk about numbers. They're actually going to use verbs and linguistics to describe their firm. And at the same time, they're going to speak it. Unfortunately, or fortunately, depending on your perspective, most conference calls are not video. And so all you're able to do, unlike seeing Mohan and I here today, you'll only be able to hear the manager. And so as of now, there's not typically video broadcasts. And so our research jumped off on the notion of we can hear managers. If we can characterize information in their voice, perhaps we could learn more about the firm, perhaps we could learn more about the manager. And that's the purpose of this series of studies, 3 studies that we described on the pre-recorded video. And just briefly to recap those as kind of a starting point for some of the questions and topics we'll discuss, briefly what we did was we said, let's go ahead in earnings conference call audio files and carve out the CEO, carve out the CFO, and we'll focus on one individual's voice and see if we can parameterize or measure emotions from their voice and see, in fact, if the stock market appears to be reacting to how the manager sounds. And we're all familiar in daily life when someone that we know sounds upbeat or sounds down. Typically we infer that something good or bad has happened to them. Same thing in the capital market, and that's what the first finding of our papers are. It appears that the stock market is reacting in a manner consistent with acknowledging that CEOs communicate to the market non-verbally with the way they sound emotionally. And so that was the first finding. The second finding was trying to use the negative emotion side in particular as a predictor of bad things to come. And so in financial markets, we all have read a lot about financial crisis and Enron and Arthur Andersen over the years. And so obviously capital markets are interested in trying to predict doomsday events or really bad events that happen at firms. And so we thought, maybe negative emotion is one of those things that can help predict that. And so our second paper primarily is documenting that yes, we can predict with some above chance levels of accuracy when a firm will enter into a financial restatement. And then the third study backed away from trying to predict anything about the firm or understand anything about the firm per se, but rather we say, can we understand something about the human being who's actually speaking? And so in the third paper, we measure voice pitch, just literally the highness or lowness of someone's voice, and use predictions from actually some colleagues across campus at Duke in biology who have run experiments that have shown that deeper pitch voice individuals are viewed as individuals with higher, what they call leadership capacity, meaning they have traits or the voice connotes traits or perceived traits of executives or leaders that are viewed as favorable. And so we just tested that implication in real world data using the CEOs on the very conference calls we study. Because again, conference calls give you the window to measure some of these biological traits that are otherwise unmeasurable for many, many individuals. And so we measure those and we show associations between how the CEO's voice pitch, deeper voice CEOs get to run bigger firms, they in turn get paid more money and they have longer tenures. And so there's these, what we call labor market benefits to having a deep voice. And so that's at a high level. We're just, again, leveraging the conference call setting where we get to hear CEOs to measure information perhaps about the firm and perhaps about the CEO themselves. And so that's the backdrop for a series of studies and continued research in this. As Mohan mentioned, we've been working on these papers for, I guess, 6 years now. And we continue, this is kind of the forefront of establishing the role of information or potential information extraction from a non-traditional venue, if you will, because for years, as might not be surprising, accountants have studied the properties of accounting numbers, the information in accounting numbers. More recently, it's moved toward understanding linguistic usage or the uses of verbs, the actual word said, when describing a firm. And our research is adding another dimension to that by thinking about how voice can communicate information. And so, with that, I think we'll try to take some questions and think about some of the thoughts that you've had. And so Mohan, I think, has a question.
One of the things that I want to elaborate on what Bill said about how it took us 7 years, and you might think research takes that long usually, but in our case it's particularly challenging because when we think about audio files, compartmentalizing CEOs' voices is a challenging task because when we are talking about conversations between analysts, investors, and the managers, there's going to be cross conversations happening all the time. So for us, one of the biggest challenges that we faced was identifying the specific nature of the conversation and identifying the conversation piece by specific individuals, because Bill's intonation is very different from mine, so we have different voice pitch, we have different intonation, different styles. So to capture that, we need to identify the specific speaker and isolate them. And that has been a big challenge for us, and it took us a lot of time and energy to, so one might ask why it took us so long, because it was a challenging task compartmentalizing the audio files. But it has been a very rewarding experience for us, because I think we found some really cool research insights that are particularly have important implications for the capital markets. Now, I had one question that was sent to us before. Actually, it's a two-part question. So it is from Dr. Virender Goli, one of our VEMBA graduates of 2006. He says, fascinating research, subtle emotional cues can be multifactorial. So would like to know of any confounding factors. So what are your thoughts there, Bill?
Well, I think that's a great question. And I think when you think about how someone conveys emotion to you in real life, it comes through in many different ways, particularly if you're face-to-face. So hand gestures, facial features, the combination of attributes certainly is something that likely conveys emotion from one individual to another. I guess one of the benefits of conference calls that just happen to be the case is because they're not video, it's difficult to ascribe some physical feature or some hand movements or facial movements of the CEO because no one can see the CEOs, which works well from a research standpoint in that we can rule out that there's confounding effects from hand gestures, facial gestures. But it does limit the scope of what we can say because in real life, certainly emotions are conveyed in a multifactorial way. And so it does, from a research standpoint, enable sharper inferences, but again, it does highlight perhaps a narrow aspect. And going forward, hopefully, as video becomes more commonplace, maybe we'll be able to expand the set and see how the interplay or the combination of ways in which emotions are conveyed can be measured in large samples for CEOs, for example.
Yeah, but I think one confounding factor we did control for in our paper is the word choice. Right. Because we know that managers choose certain words in a particular way, different managers choose different words. So there's a lot of stream of linguistics research that have methodologies where they can synthesize what is being said. Right. So in our research, we are careful enough to control for that confounding factor. But there are other potential confounding factors that Bill mentioned. I think that'll be a challenging exercise, but I think that is something that we could possibly do as the conference calls maybe gravitate towards a video and audio presentations as opposed to just an audio presentation. One of the things that Bill and I are thinking about, a context where this might be very relevant, is the annual meetings. I think annual meetings are more open to video as well as audio, and I think that may give us the opportunity, tremendous research opportunity to explore these confounding factors. Now, talking about annual meetings, and I'm sure many of you are aware of what happened to Facebook founder who was grilled during this recent annual meeting about the performance and the plans for the future. So those are very interesting avenues for us to explore, which we haven't done. I'm sure in the years to come we'll have research that kind of takes into account and encompasses a broader range of human emotions and display across both facial as well as audio features. Now, the second part to the question, which is actually a very interesting one, is it would be interesting to know how training can change vocal characteristics. So let me take a stab and I'll let Bill add on to it. And I think, we have been approached by some consultants who, after seeing our research, especially, they particularly like it because these are consultants who help CEOs with proper intonations and appropriate way of hand gestures and movements and facial expressions. And it is very clear that there is a room for this. There's a role for and opportunities for training in these dimensions. But in our view, it can be only done so much. I think there's a limit to which one can be trained to change their vocal attributes, because once somebody gets emotional, I think all of this training goes out of the window usually. Because one of the things that consultants tell CEOs and executives is to have a common intonation, keep their emotions in check, keep their body gestures to a minimum. But it is all a matter of how somebody gets grilled. So you can imagine when the Facebook CEO was grilled by certain adamant investors again and again about a question, it's only a matter of time, potentially, that there's a breaking point. So we don't know how people respond to this, but it's an interesting question. Right. And of course, there is a room for training, but at the same time, I believe that we are going to have opportunities I think there's a limit to which this can help. Bill, your
Well,
thoughts?
I think in everyday life as well, if you think about if you're trying to portray an emotion or trying to hide an emotion, for example, people that know you pretty well, they know when you're being forthcoming with how you feel and when you're not. And actually, the setting that may differ from perhaps a politician or an annual meeting for a CEO is these earnings conference calls. These are repeat interactions with the same analysts. It just so happens that they're in public, but they're on the phone with the analysts all year long. This is a repeated interaction, much like it is in real life with loved ones you have, that you interact with a lot. And once people really know you're normal, your baseline, how you behave when you're in an unemotional state, deviations from it are easy to detect. And so we're in a setting where, yeah, you might be able to mask it, but we had a discussion in one of the classrooms we were in with John Graham, where one of the CFOs of a major company, said, hey, on a conference call, I had a bad day. I was just sick, and my voice sounded different, and analysts took that to mean, things were bad at the firm, and it took months or weeks for me to convince all of them. I had to go to them individually, and again, I think that just highlights the fact that these analysts who managers speak with, they know the normal of the CEOs quite well. And as a result, this whole notion of can someone be trained to maybe not elicit emotions, I would say perhaps, but the benefits of it, it's difficult in this setting at least to believe that you could fundamentally kind of fool or be hide your emotions from analysts who actually know you so well. Because in fact, we are studying the largest of the large corporations in America.
Right.
And so, in that context, the room for this, I'm not saying that there's none, but the benefits of it might not be as salient as they could be in other settings.
Yeah, we don't believe that the CEO population are pathological, liars are pathologically different from the rest of us. So I'm sure that at some point in time, as Freudian slip will happen, something will give, whatever training that they have.
So we have a related question that's come in, and let me articulate what this is. The question is, have you measured how much the analyst voice or the emotions of the analyst affects the CEO's voice as they reply to questions? So the notion of, is there some dynamic between the analyst and the CEO in terms of one emotion maybe translating to another, or one analyst emotion translating into the CEO?
This is a fantastic question. I think this is something that we have spent a lot of time thinking about. There are a couple of challenges, but I think we are working through this. There is a recent paper actually on the linguistic side, which has actually looked at what kind of questions that are being asked can help us understand the information in the conference call. So on the linguistic side, people have evaluated the analyst questions, the word choices, whether it is strong positive, strong negative, those kind uncertain, those kinds of issues on the linguistic side. But I think you raise an interesting point on the audio. Does the analyst sound very negative such that it may influence the CEO's thinking? Now, what we have done is we have actually, Bill has just started this data collection mode where we're going to compartmentalize the analyst speeches different from the CEO speeches and do turn-by-turn talk. And then we haven't done analysis yet, but I think what we are hoping to see is we're going to see some reactions to how analyst questions may have a bearing on the particular reactions by the CEO.
Right.
And where is it at this page?
Well, so in order to do research like that, just to be clear about what we've done and how we've thought about this in our current research is simply trying to isolate an average notion of what the CEO's emotion profile is during the question and answer session, and then we look at how the stock market reacts to the firm. So it's a very much a firm level phenomena that we study so far. The suggestion here, I think, is more of a refinement where we get more at the dynamic interchange between an analyst and a manager. And currently, to do a good job with that, and get sharp predictions about how that dialogue, to guide our thinking about what we should expect to see or what theory might predict, we kind of need to team up with experts in other fields. And so we're actually working with some individuals in communication and technology at the University of Arizona who actually have developed theories and study theories, primarily in laboratories, about how synchronous, for example, if a firm or someone's trying to be deceptive, they do a lot of research on interrogations, police interrogations, and the synchronicity with which voice, how much synchronicity there's between the interrogator, in our case the analyst, and the CEO, which would be, I guess, the suspect in some sense, How synchronous they are actually indicators of whether there's perhaps fraud or perhaps an emotion profile. That dialogue can help us uncover sharper measures, if you will, for understanding the emotion profile of a CEO. We also can learn a lot of things about the analyst. So, for example, analysts have as much at stake as managers do in the game. They have institutional clients who are listening, and if an analyst asks a silly question or gets in a public, negative public exchange, perhaps with a CEO and an investor's in a long position, they might not be too pleased with how the analyst and the manager are dialoguing with each other. And that's another facet of this research that regulators care about is, they want honest information sent to the market in a forthcoming manner. And to the extent that analysts want to get on a conference call and perhaps not rock the boat, there's actually research, and part of my dissertation was about that, was do managers actually select friendly analysts, or the ones that are most bullish to talk with? So in other words, the data shows that managers tend to pick more favorable analysts. And there's a recent research paper out of Harvard in a related case that kind of shows if you characterize firms based on the ones that tilt who they talk to in a favorable manner, those are the firms that underperform in the future. And so there's a lot to be learned from this dialogue.
Yeah, this is so-called avoiding the David Einhorn effect, right? I mean, that if David Einhorn is going to have a negative statement about the firm, it's going to have negative consequences for the firm. So you can imagine the managers would be more reluctant to, when they see a question from David Einhorn, they may put him probably on the 4th or the 5th on the list, because by that time, perhaps the upbeat clients have asked the right questions, and they can put the whole room or the investor clients in a positive mood before the negative questions come to the fore.
Right.
Do you have another
question?
Yeah,
we do have another question.
Okay. How do you separate the more objective news of the numbers reported from the speaker's subjective tone?
And this came from
Amy Auditot from 2009.
So separating the objective news from the subjective news. So this is a conundrum, or not a conundrum, but an issue that has been studied in accounting, I think, for decades, thinking about the accounting numbers. So you remember back to when you took core financial accounting from us, that there's a lot of subjectivity in terms of the numbers that are reported, where managers have some leeway, if you will, to select a number that hopefully portrays the true economics of the firm, or is the objective underpinning economics of the firm. And of course, we discuss settings where, maybe managers have incentives sometimes to maybe not give you the most objective number and inject subjectivity into the actual numbers you see. And so this question parallels that exactly in terms of, how does the manager sound, or how do they, what words do they pick, and how do you separate out the objective from the subjective? And I think there are techniques, that are, the intuition is if you can build a sharp enough model of what normal is for that CEO. So there might be some, people in your daily life that are just optimistic about everything. And so for them to have bad news is any sort of lack of optimism is very negative. Yeah. And so it really depends on what the baseline is for each individual. And going forward, we've been continuing to collect data. As we can build stronger and stronger time series or more observations of the same individual over time, we're able to get a sharper measure of what we should expect, and then measure deviations from that to see if that subjective component actually contains news.
Yeah, the software actually that we use is supposed to capture the subjective tone in the sense that calibrate each person's voice at a base level and then look for perturbations from that point on. So hopefully, if the software is doing a good job of capturing the subjective tone, we should see some correlations between the subjective tone and how the market participants react. So when Bill described our first research question, that is exactly what we tried to accomplish. And we did see a significant correlation when the subjective tone was negative or when the subjective tone was positive. The market reacted negatively or positively, as the case may be. And your point is also related to the first question about confounding factors. All you're saying is, hey, we have a lot of objective information that's coming from the financial reports, assuming there is no subjectivity in the financial statements themselves. What we are saying is, in addition to that information, you can actually glean something from the manager's talk because we can capture something from their subjective tone. Now, what is, however, something that we have not explored is how that subjective tone can tell us something about the subjectivity in the financial statements themselves. That's an interesting interaction effect, where we are saying, oh, if the manager is going to talk about pensions and post-retirement obligations, maybe the numbers that are reported in the financial statements are somehow subjective. Can we learn something from that? I think we have not gone into depth in that particular realm, but I think that's a very useful direction to go. I think you're talking about a very important element. We are not able to do it currently because at the moment we are not doing context by context. We are just listening to the CEO's voices and let the software tell us whether it's a positive subjective tone or a negative subjective tone. But I think we have to be context specific. If the CEO is talking about revenues, now can we see that has an interaction effect on the revenues? And what does that have to say about market response to revenue numbers? I think that would be an interesting question. And with the new data that we have started collecting, where we have turn-by-turn talk, we can actually go and contextualize the actual statements that are being made by the CEO that can give us some calibration about how it may have an impact on this.
Right. And one related point, once you, to note the difficulty, so conceptually that sounds like a great idea. Financial statements are meant to be comparable. So all these accounting standards and everything that we see in financial numbers are meant to be presented in a way that you can easily compare them across thousands and thousands of firms. These conference calls, however, they're voluntary disclosures. So there is no mandate that they have to talk about particular topics. There is no mandate that they have to talk to certain analysts. There is no mandate that they have to have, for example, the CFO discuss one of the underpinning assumptions of a given accounting number. And so it's not always easy at some firms, for example. You may be interested, for example, in is the subjectivity in the accounting numbers, can I learn anything about them from the discussion? You can if they talk about the topic. And so because it's not regulated, you're not always able to see topics that you might want to see discussed. However, there are a number of instances where when things go bad, you can go back in time. You can go back in time and say and look for particular topics. And so, those are all research ideas that are on the table for us that we're actually, going down that road now to try to see if we can learn something much deeper than just in a cross section of firms. Is positive emotion responded to as if it's a positive emotion by the stock market? Can we learn more? I think we can learn a lot more.
So you raise an interesting point there, Bill. Do you think that our research have implications in a regulatory sense? So do you think regulators will read this and take some cues about what to do next? What are your thoughts?
Well, I do think from a very practical standpoint, we haven't really talked about auditors as a regulator, but they're implicitly a regulator. Now, I know they're customers of the companies. However, companies have to have audits, public companies, and auditors, as part of the auditing standards, have to look for cues, or they have to make fraud risk assessments at firms. And in the literature and the authoritative guidance now for auditors, it says you should listen to conference calls. Now, that's the end of the sentence. So you really don't know, well, what are they supposed to listen for? How exactly should that be mapped into their audit evidence or their fraud risk assessments? It's basically, I think we're at the point where I think everyone agrees that there's important information to be learned. Characterizing exactly what can be learned, how good that information is, how precise that information is all things that we can understand from a research standpoint, and then hopefully that would guide regulatory refinement of an auditing standard, or for example, to guide auditing firms in terms of, what should you listen to on a conference call? What should you compare it to? Should you compare it to the numbers from this quarter? Should you compare it to 4 quarters ago? Should you compare it to the CEO versus the CFO? We haven't even talked about that, but it's a rich setting to study, to perhaps glean a lot of insights. And I think the articulation of what insights you should be gleaning from a regulatory standpoint really isn't well understood, because I don't think regulators have a good grasp of what the nature of the information content is in the first place, which is kind of the void that we hope to fill with these series of studies.
I think I'm going to go one step further here. I'm going out on a limb. I think that the fact that we have demonstrated that there's information contained in the executive's voice, and one of the things that Bill mentioned is there's no mandate that is requiring firms to actually do these conference calls. It's a voluntary disclosure in the sense, but you'll find that most companies do have conference calls. And the key insight here is, although all of them are allowed to actually listen to the conference calls, they are not allowed to ask questions. So going back to Bill's research, I think the participation nature has to be more less systematic and random than it is meets the eye. We don't know the ramifications of that. The second point is, one of the challenges that investors would face is, if I have to go back, and Bill mentioned that if you want to go back and see if this information was contained at some point in the future after the fraud was detected, it is hard to go back because firms do not retain the audio files for a very long time. And the question is why? I mean, they keep financial statements ad nauseum going back to the 70s or 60s, or when the firm actually was incorporated. But if you look at the audio files, take any firm, and if you go to their investor relations website, you will find that the audio files are available only for the last conference call. And if you want to go back and listen to 2 conference calls ago or 3 conference calls ago, so you can have a benchmark and see if there is a subjective tone difference, you cannot do that. It's an interesting question as to why firms are reluctant to keep it on the public domain. And it is not space constraint. Now we can have terabytes and petabytes of data, without much expensive or costs. But I think this is an important regulatory implication, I think, in the sense that I think this is a useful data that might be relevant for investors, and I think this should be retained. I think that's the way I would view our implication of our research.
Just to follow up on that too, that's not to say that the transcripts, though, of what was said are not available. They're available. Yeah. So amazingly, the audio is typically the ability to restream the audio it's in control of the firm, and they restrict access to it. Now, that may be coming to an end to some extent. So a lot of the answers that we receive from firms as to why they do this, they cite regulatory and copyright. So they'll say this is a copyrighted broadcast. Any retransmission is prohibited. There have been firms that have popped up that actually provide restreams, or basically they'll record down the conference call while it's live, and if the firm turns it off, they'll just provide that audio recording. And there's actually been lawsuits in the last year about that, about whether there's fair use, or that's a public, that broadcast really can't be copyrighted by the firms because it's part of Regulation FD, or being disclosure, forthcoming with disclosure in capital markets. And they appear to have ruled so far in the favor of the, not in favor of the firm, so in favor of the investors of, if you record a conference call, you can record it and keep the recording and rebroadcast it yourself. And so if the tide is shifting in terms of the litigation environment, going forward, I think we may be able to build a better repository of the history of the conference calls. Now, fortunately for us as academics, if you analyze this stuff in real time, which is, I guess, part of the job we do as archival researchers, is we look at real data over time. And so we've been able to build up kind of a benchmark model, if you will, for CEOs over time. And I think, going back to the point from before, to the extent we can do that well, we'll be able to really characterize what's the normal. What is the normal for a given CEO sound like? And then once you know the normal, you're able to study a lot of factors like, for example, innate voice pitch or other sort of acoustic features that are innate to the individual, and also be able to measure deviations from that normal, which would be the markers of emotions. And so we hope, both of those streams we hope the data will be able to help us speak more sharply to those issues in future research.
So what do you think are some of the direct applications of our findings or this research in general?
Well, I think from the interest we've gotten from, for example, hedge funds. So, of course, hedge funds are in the business of making money trading in the stock market, and so their view is, if there is a systematic way to sort firms to develop trading strategies, that's one interest in terms of practical applications. A different one is from the analyst perspective. So analysts, let's just take off the table that we selected what analyst, let's just assume there's an analyst that shows up on a call. They're interested not only in their conference call, but understanding what happened on competitor firm conference calls. So analysts, financial analysts, typically cover firms in a sector or an industry, and they cover all firms. And so they want to be able to listen to another conference call and actually calibrate or figure out, how does the CEO of that firm sound? How does the CEO of the firm I'm talking with, the CEO, how do they compare? And so I think that's a practical aspect from an analyst perspective, not necessarily in, can I sort stocks in a particular way, but can I triangulate what's going on in the industry? Because if you really push and say, where does the value of a financial analyst come from? I think the evidence is leaning most towards their industry experts. And so I think they care most about understanding as much as they can about the firms they cover, which are typically the set of firms in the industry that they're assigned to.
What about the research on voice pitch and the notion that deeper voiced CEOs make or running bigger firms. Do you think they have that particular result has implications for the boards who happen to choose the CEOs?
Yeah, well, so I guess our evidence is suggesting that the boards of directors who make the hiring decisions in the labor market for firms are actually matching up deeper voice CEOs with larger firms. Now, the immediate question is, well, why is that? Well, where's the benefit coming from? And I think, we've only scraped the tip of the iceberg on that. And we've only, so to be fair, we've only studied males. So we're looking at conference calls of S&P 1500 CEOs because those are the ones we can easily measure compensation data for. They're just as an empirical fact, there just aren't enough females yet in the CEO position. There are in the CFOs, and so that's something that we possibly can expand our analysis if we consider CFOs and get a larger set of female executives. But the research in the laboratory over from Duke Biology, for example, who has done studies on the role of voice pitch and perceptions of leadership based on voice pitch, they don't just focus on males. And in fact, their most recent finding is that among males and females, as we mentioned in the pre-recorded video, deep voices for males and females are viewed as advantageous for leadership selection. And so, to the extent that translates to females, to the extent that boards are actually believing some tangible benefit will come from a deep voice,
but
we don't really know the answer yet.
But isn't it true that the females, on average, have a higher pitch biologically than males? So does it have anything to say about the recent discussions about the number of women on the C-suite?
Well, I think that's one of the intriguing punchlines from the experimental research that was conducted over in Duke Biology was perhaps this has implications for the glass ceiling. So let's assume, for example, that there's just a preference that deeper voices, I don't care who it comes from, deeper voices are preferred. Biologically, we know females have a higher voice than males. What to do? So does that mean that females are forever at a disadvantage in terms of getting to the C-suite? Now, this is actually a very important question, and to put a research angle on it, what we're doing now currently is we're actually teaming up with the researchers in the biology department to see, can females do anything? So in voice pitch, you do have the ability to change your pitch within a limited range. So I can't, suddenly have an innately high-pitched voice, but I can raise and lower it a bit. And there's actually a notion of this thing called vocal fry, which has been ascribed, for example, for females that are in investment banking. A lot of the female executives have been, if you Google, for example, vocal fry in Wall Street, you'll see that the intuition there is that if females perhaps artificially lower their voice into levels, into what they call the fry zone, or where your voice starts getting choppy because you're lowering it too much, that appears to be a characteristic of females that have succeeded. Now, is that evidence that if you try to manipulate your voice pitch down, that has some benefit? I think it's a narrow view. I think there's a lot of factors that go into the selection of a CEO or an executive. Voice pitch certainly is perhaps one of them. But I think understanding the implications of your natural voice pitch, any sort of variation that you can inject in it artificially, even to the point of damaging your vocal cords, which is kind of the intuition behind vocal fry, is you can actually damage your vocal cords if you do that too much. And to the extent that confers benefits, and that's a strategy actually for female executives, remains to be seen, but is certainly has been forwarded anecdotally at least as perhaps an optimal strategy. And so we want to put that to the data.
Yeah, but also I think there are many other physical attributes that have been shown. Height, there is also the height premium that's been demonstrated in economics, beauty premium as well. So I guess when we are talking about the vocal fry or vocal attributes, I think one has to be cautious in terms of taking it to the extreme. And I think I'm taking the devil's advocate here in the sense that the vocal characteristic is one characteristic of the human physical attributes, and one cannot argue it's not a causal relationship, but it is actually one of many factors. And it also goes back to the question earlier on about confounding factors. So when we're talking about people in the C-suite and selection of females and males in the C-suite, I think the biggest challenge is what are the various attributes that can help someone get into the C-suite, and focusing only on the vocal attribute would be a touch too far. But I think it is important to understand, I think what our research says is it is important to understand that there is possible benefits associated with the low voice pitch. It doesn't mean that CEOs of big S&P 1500 firms or Fortune 500 firms have actually deep voices, and there are some who are actually in high upper echelons of management who have higher voices. Maybe they are taller individuals. So there are compensating physical characteristics that may drive their position in the firm. Of course, we are well aware of Napoleon on the other side, right, who has actually heralded the forces, even though the nature of his height. So I think keep in mind that there are going to be other physical characteristics that can play a role as well. So we're getting close to the time here, but can you tell us about the next steps that you're thinking about in your research agenda, apart from what you have done so far?
Yeah, I think as we've kind of highlighted, we've just scratched the surface, if you will, on understanding what information can possibly be conveyed from voice. And I think some of the natural offshoots, obviously within voice, have to do with the analyst-manager dialogue. We haven't really talked about, for example, there's research on how dialogues converge. So in negotiations, for example, in courtrooms or when there's settlements being negotiated, there's research in those domains that suggests that the pattern of language, the pattern of speech, actually changes as two parties converge on agreement. And if you think about what happens in capital markets, and this is very fundamental to what we study in accounting conceptually, is if you're a firm and you know how your firm's going to perform, you want to convince an audience of that. The audience are investors, and who work on behalf of investors? Analysts. And so that dialogue with analysts, what we care about understanding after a disclosure event from CEOs is, are all the analysts on board? Do they understand? Are they buying into the story or the thesis that the manager is forwarding?
And this goes back to the question early on about how the analyst interactions, about the CEO, the dynamic of CEO pitch, and the analyst pitch can have an implication.
Right, and if they co-vary in a particular fashion, which there is research to suggest that would guide our thinking about what patterns those might be, it'd be fantastic to know. The benefit, one of the benefits of a conference call, for example, is that that's a venue where, because it's live, we can actually measure the extent to which analysts are converging into agreement with the firm. So it need not be a story about managers are trying to fool someone or they're trying to paint a rosy picture of the firm. Let's just assume that they're just trying to understand fundamentally what's happening in the firm. Can we measure that convergence? And that's an important issue because in capital markets, you care about beliefs converging on a particular expectation about the firm's future. And the dynamics by which that happens, we're able to actually observe it. Where we haven't ever been able to observe it before, and I think we can measure things there. So that's a path of the research that I think definitely stems from this dialogue interaction, but at the same time can lead to questions that we really haven't even explored yet.
Yeah, and in particular, I think we have only talked about auditory cues, and I think we haven't even scratched the surface on the facial cues. Right. Bill and I have done some analysis of the face height to width ratio, telling us something about the testosterone levels or the specific nature of the individuals in the C-suite, and we have just begun to explore this. And maybe in a future faculty conversations, we'll talk about our findings about how the facial cues can have a bearing on investors' interpretations about the individual themselves and the firms, and what is happening in terms of the actions taken by the managers.
And the same parallels that happen to voice happen with any sort of other physical feature. For example, Mohan mentioned measuring certain dimensions from a picture of your skull as an indicator of various testosterone levels. So that's an innate, unchangeable, if you will, feature, as opposed to facial movements that express emotion, so smiles, for example.
Although we did talk to a doctor at the Duke University about injecting testosterone levels to possibly change the voice pitch. Of course, it'll have to go through some IRB approvals and all that. We haven't gone that far yet.
Yeah, but the thinking's going in that direction. So I think the point of that, too, is that in order to get to the notion of multi-factor, like the very beginning question we had from today, you do need to think of these are human beings that are running firms, and they carry with them all the factors that human beings bring to the table in any domain. It's no different for a CEO. It's not that CEOs are some black box computer that sit that just get inputs and give outputs in a very systematic standard economics framework. They're human beings too, and so I think all the features of being a human being that apply in every other discipline actually apply here, and we're really at the forefront, I guess, of being able to actually measure some of these things in systematic ways, be it because of changes in regulation, which allowed conference calls to become systematically in the capital markets, if it's technology for measuring voice. The simple nature of measuring voice pitch 20 years ago was non-trivial. Now it's quite trivial. So software technologies, the availability of audio files have really opened the door to investigate lots of different aspects of the human being that is the CEO, that is the CFO in the C-suite. And I think if we can touch on the importance of and characterize the importance of those individuals, we can learn a lot more about how corporations operate, which at the end of the day is we're in a business school. That's our job, is to understand that better. And so I think that summarizes, I guess, where we intend to take this literature going forward.
I guess we have been shown the time.
All right, so it's been fantastic to discuss our research. Obviously, it's been our pleasure to be with you today. I hope the discussion was thought-provoking. It always is for us. We always appreciate the opportunity to reconnect with former students and Fuqua faculty. Just so you know, you can always submit additional questions or comments on the website, or email Mohan or I. We'd be happy and thrilled to respond to any follow-up questions you might have. So with that, on behalf of my colleague Mohan Venkatachalam and all of us here at the Fuqua School of Business, I'm Bill Mayew. Thanks very much for being with us today.
And the next Fuqua conversation will happen in August, and we'll give you more information soon. Thank you, and so long.